which will be completed in the next couple of months and ready for any other potential hires. Still seeing the fairly low demand for the rest of the development gear, and that's the sort of shuttle cars and breaker feeders. So whilst we're quite confident in the utilisation with the miners, and obviously they make up a large chunk of our equipment, we're still seeing fairly low demand for the shuttle cars and the breaker feeders. So it'll be good to see these development contracts come through, because that's certainly where that gear will go into. With our smaller equipment, it's predominantly engaged on internal projects, and the utilisation rates on that gear remain at pretty much normal levels. And as Chris said, we expect the utilisation rates to slowly build over 2014, and we've certainly seen that starting to build late in 2013. And again, to labour that point, those development contracts coming up are critical to that. I'm on page 15, our engineering business. Very strong performance in 2013. During the year, they secured a major contract at the new Grosvenor mine to manufacture all the QDS equipment for that mine, and that gear will be delivered through 14 and also into 15. So a very good contract which will support that recurring revenue that's generated out of the engineering business again for 2014. We've also secured a new forward purchasing agreement with Ensham Mine for 3 years. So as Ensham's moving into underground operations, we're now supplying those underground consumables, and what that'll do is position us very well as Ensham grow and expand their underground operations, which they intend to do. We've also renewed the forward purchasing agreements with BMA for all their Queensland sites for 2 years, and similarly with Anglo for a further 2 years as well. And to renew those contracts, we have given up some margin, but we've been, again, quite strategic on how we've done that. We've also, to compensate for that, we've gone out and sourced cheaper products. We've spent a lot of time working with the Chinese to find products and bring them into the country at cheaper rates. So whilst we've been able to deliver a cost saving to the customer, we've also been able to offset any margins that we've had to give up on local products by supplementing our product offering with overseas products. So it's been quite a significant piece of strategic work to secure those FPAs going forward. We also focused on right-sizing the business, as Chris alluded to. That business is subject to fixed costs, which we need to have in that business to maintain the fabrication facilities and all the QA around that. As I say, we've focused on right-sizing that cost base to make sure that we maintained our competitiveness and, importantly, preserved our margins as well. And as I mentioned there, we've developed those strong ties into China to be able to expand our product offering and bring new products into the marketplace, which is offsetting that margin product and gaining us favour with our clients, because we've been able to bring a lot more products into Australia at much cheaper rates overall. So FY14 outlook for the engineering business is looking very similar to 2013, and the guys have done an excellent job up there in securing all that work. Services, we've spoken extensively about this one project, which is now completed, so we certainly see that for 14 the revenues will be well down on where we are on 13. I guess the point I want to make here is that with that service business, we're committed to keeping that business operating, because it maintains the full range of capability for Mastermyne across the board when we go into a new project, having that surface capability as well. What we're able to do is when the services business does ramp back in revenue, it is a very low-cost operation. The people that are in that business, or the key people, are absorbed in other parts of the core business. And what we're able to do then is when the opportunity presents, like the KME project, we've then got that capability still in the organisation to take advantage of those sorts of projects. And whilst we see that the work based on those new projects will be fairly soft in 2014, there are certainly some good opportunities coming in late in 14 and 15 for that services business. So we'll continue to operate the services business. The mine site business is continuing, which is a continuation of our mine start business. Has been very quiet on the training front, as you appreciate with the slowdown in the market. Labour demand is not as high, not as tight, so we're not doing as much training. But the consulting side of that business is going extremely well, and they've secured a very large contract with a Tier 1 coal company to do all the training across all their Queensland sites, and also extended the training for the Anglo-American sites as well. So again, very strategic part of the business and rounds out the services that we provide. On page 17, we'll step through the order book. You can see the projects there, the first two being Oakey Creek and Moranbah, are up for renewal in October, November, which I spoke of earlier. The Moranbah North umbrella contract, which has been extended to February, and then the tender is due out for that project later this year. The Crinum mine, we can see there we've coloured that to show the preferred tenderer option, that will preferred tenderer status, which will extend that contract out for another 2 years. Westcliff is continuing with no changes. The Abbott Area 9 project came on in January. The next one down is the Kestrel mine drivage, and that's at the existing or the old Kestrel mine, and that project will run off with the closure of the mine, which is expected from the roadway development point of view will be later in this year, sort of October, November this year, and they'll finish longwalling sometime early next year. And then you can see the Kestrel mine services and the Kestrel strata support projects, which are then sort of the renewal of that project and the KME projects, which go out for the best part of 3 years. The Grasstree mine is the new site that we spoke of. The Carbra Downs project is the other new site. The BMA Stone drivage is, as I said, 10 months initially, with some good opportunities there for roadway development continuing on the back of that. And then the last two new contracts were the Dendrobium mine services, where we replaced an existing contractor on that site, and the Dendrobium longwall, which is a fixed piece of work for around about 6 months. So the total order book there in value is 236 million, of which 113 will be deliverable in FY14. Our recurring works of 30 million, which is our non-contracted and engineering works. And then we've got the FY14 contribution of the renewals is approximately 20 million. Moving to page 19, the general outlook, is certainly well documented that contractors and mining services companies have been the focus of the initial actions by coal producers to achieve that immediate cost relief. But it's our view that contractors will play a strategic role going forward in lowering costs of operations on these new sites. So particularly where we see where any new startups, any attrition on these projects, and any ramp up as the sector recovers, will be opportunities for us to grow our business, because we see that the mining companies will use contractors as opposed to engaging fixed labour or their own labour at this point in time. We've certainly seen a shift from producers towards contractors that are more effective and more efficient and who can reduce their cost of operation. So we've been through some significant tendering in the last 6 months, and that has really been around testing the market and to find the most effective and efficient contractors. And as I say, we've evidenced that in the increased number of tenders, and we've certainly been able to replace contractors on sites and win new work as a result of that tendering activity. We also see that our market share is increasing as these smaller and more inefficient contractors lose their contracts or exit the sector altogether. So in the boom of the market, we saw a big influx of small contractors, guys that had anywhere between 20 and 50 people. and we've now seen those people exit the market. So whilst a lot of that labour hasn't been replaced as yet, we certainly see that as the sector recovers, those contractors won't come back, and that will create more opportunity for Mastermyne to increase its market share. We've also, in the next point, we say history has it that the contracting market will always grow following a slowdown in the market because of the fact that coal companies will be very, very cautious about introducing fixed costs back into their business. And typically what we see is very much an uptick in contractor services following a downturn as work that wasn't done during the slowdown needs to get done. And as I say, owners are very cautious about putting on fixed costs in their business. And the last point is around the coal volumes. We're certainly not seeing coal volumes decrease, even in the current market with the current prices. We're seeing record volumes of coal go through the ports, and obviously all of that supports the services that Mastermyne provide. So on page 20, looking particularly at our business, we see that we're very well positioned to grow because we've maintained our existing contracts, and we've also been able to bring new contracts through. So we've maintained a very strong presence on all our sites and also increased the number of sites that we're working on, and that'll be the catalyst for more growth when as the sector recovers. Again, these new sites provide the entry point and the platform to expand because we are the major contractor on site. And the way we've set this business up, where we provide all the full suite of contracting services, so being the contractor on that site with people and contracts in place, positions us very well for any increase in scope and any new contracts. The tendering pipeline, again, very, very solid, and with over 900 million in tenders, with 378 million in active tenders, and that's made up of about a dozen contracts, of which two of those greenfield sites, which account for about 1/3 of that tendering pipeline or active tendering pipeline. And we see that the remaining tenders are certainly weighted towards the second half of this year. So we're not expecting to see many more contracts delivered in the first half of this year, but certainly some good opportunities in the second half of this year to bring some of those new tenders through. As I say, roadway development tenders not currently in the pipeline. We're expected to see more of those in the next 6 to 12 months, as all the work that's been deferred around roadway development will start to come back on, and that creates a lot of good opportunities to deploy our fleet, which obviously goes a long way to our recovery in the margins. We're also seeing more short-term contracts. So these are short duration contracts and also labour hire style contracts. None of which are new to the business. We're certainly able to handle that sort of contract, and we again see them as quite strategic because it provides us with more opportunities to get on more sites, and to, once you're on that site, to be able to expand the range of services and stay there longer. So it's all about that ability to get onto site and then look for other opportunities to stay on the site. The industrial flexibility, again, is very, very strategic and has us very well positioned in the marketplace, and it's really been critical to us securing new work, and we'll continue to be critical for us securing new work because we've been able to bring cost savings to our clients, but at the same time maintain our margins. The equipment utilisations, as I say, certainly some positive signs there around that starting to return to normal levels, and we see the performance in FY14 underpinned by that current order book and that recurring works, track record on renewals and that recovery in equipment utilisation and that contribution from the